So from a strategy perspective, we have started our Infinity Hybrid Long Short Fund in the SIF category. I will give you small background on the SIF category. So SIF were actually launched by SEBI in Feb 2025, and the reason why they launched was they realized that markets are tilted towards only one thing, which was, if you see in the cricket side, I will give you an example of cricket. Suppose, I mean, the cricket field is diversified to 360 degree, and typically a player is good in offside, good in leg side, and typically a all-rounder play like a 360 player will hit you every side. But suddenly you will see a player like a Kevin Peterson, which is a pure leg side player, and now he is hitting everything on the leg side. So what you will do as an opposition captain is basically bowl on the leg side, and you put every fielder on the leg side. Now in that case, the runs get choked up, right? You can't hit because everything is tilted toward leg side, and all fielders are also on the leg side. So what Kevin Peterson came with a new shot, I mean, you guys must be knowing this, is a switch hit. So switch hit was introduced by Kevin Peterson, and he actually got everything which was going against him as a advantage, and he actually hit on the offside. So now what SEBI realized was that in mutual fund also everything is tilted towards leg side. When I mention leg side, it is basically your bull market. Everything is tilted. So if market does well, everyone will does well. But if market doesn't do well, we are actually at a toss. So what has happened is like 80 lakh crores, out of 80 lakhs crore, 44, 45 lakh crore is equity, and most of them are tilted toward bull market. Everyone wants markets to go higher. But suddenly in last 2 years, you have realized markets are giving you zero returns. And this has been a real problem. And once market get mature, the more market gets mature, the more it will be difficult for market to give you stellar returns. So what we have seen is like there were no players who can hit you on the offside. So for example, there were no players who can play the flat or to bear market as well. So it was there in the AIF category, but it was never in the MF category. So what SEBI told, let's introduce something which is like similar to an AIF, but with lot of relaxations. So what relaxations are there? One is basically you are not invested on minimum 1 crore. It is now reduced to 10 lakhs. SIFs are now 10 lakh category. Second relaxation was taxation. In AIF, they are taxed at 42%. I was the fund manager at Tata AIF, and I was actually managing the AIF piece over there. Despite giving you very good returns, we were actually ending up at 6.5% post-tax of 42%, largely because taxation was very, very high. So there, the mutual fund relaxation has been there. Third, which is very, very important, it is governed like a mutual fund. Don't worry on your money. It is like a mutual fund. It is a part of mutual fund company. It is not separate from mutual fund. And fourth thing which is allowed as a mutual fund, and it's not allowed in mutual fund, is basically you are allowed to use derivatives in this, which you are not allowed to use in the mutual fund space. So mutual fund always have a thing that they can't short market, they can't make money by writing options. So government or SEBI told that let's make a case where you can do all such things but in a limited way. So what are the limitations? I will explain you on this. So this is why the SIF launched. So I will say the sum of SIF is basically mutual fund plus flexibility. All mutual funds can use is there, plus there is a lot of flexibility like an AIF. So mutual fund plus flexibility is like a MF, of like an SIF. So this is the, so it will not work here, but I will try to explain you through this. So SIF minimum is 10 lakhs, AIF minimum is 1 crore. Second point I want to highlight to the all our client base is basically we are using derivatives, but rest assured it is not a leverage product. Leverage is not allowed in this. We are using derivatives not to enhance your returns, but to reduce your risk. We are not using derivatives to enhance your returns. So once we are using derivatives, there is always a cause of concern that we can blow up your account. It is not possible in SIF. We are not allowed to leverage. So leverage is not allowed as compared to an AIF. Third, the difference is basically you can allow to short. 25% you can sell and make money. It is difficult to short, but it is not impossible to short. From the few of the features of SIF, I will give you very important features. Minimum is 10 lakhs. Second is basically you can short up to 25%. Third, it is an interval fund. Interval fund are basically you can come in every time, but you can only exit twice a week. which is Monday and Wednesday. These are interval funds, and it is 2+2 settlement. Since we are actually not allowing you daily liquidity, we are giving you a zero exit load. So this fund which of ours is a zero exit load fund. You can exit anytime on day one itself. So from a risk reward, I will tell you there are few categories which I have highlighted here. Arbitrage, conservative hybrid, equity savings, and balance hybrid. I am not de-selling anything. I am just comparing what risk is there and what returns they are giving. When you see equity savings and balance hybrid fund, they are carrying a 30-35% equity risk, right? Because that is the equity they follow in their long only portfolio. We are carrying 10% and below equity. So that is the 1/3 risk which we are carrying. In Arbitrage, there is zero risk. We are carrying here the risk of standard deviation is 2%. So with 2% more risk, we are giving you more than 4% of arbitrage. If arbitrage is giving you 6%, we are trying to give you 9 to 10%. So that is the amount of returns which we are trying to make with a small risk of 1 to 2%. When we look at conservative hybrid, equity savings and balance hybrid, these are the funds which have been sold very well in markets. With a very, very low risk, it has been sold. Unfortunately, this fund also relies on market to do well. If market doesn't do well, this fund will actually fetch you 4 to 5% on an annualized basis. So we are trying to give a risk rewarded risk return which is lower the risk and similar returns, or maybe slightly below returns. But risk is much, much lower as what we are having in the conservative hybrid sides. From a taxation angle perspective, I want to highlight the team. There are two taxation in this. From a 12-month perspective, we are taxed at 12.5. Before 12 month, we are taxed like a debt taxation. So please be rest assured that before 12 month, if you exit, it will be like a marginal taxation for you. And what are the returns which you are carrying is arbitrage plus with marginally high volatility. If you can see here, we have highlighted, we are giving you 3 or 4% more than arbitrage, and the volatility which we are carrying is 1.5 to 2% more. So if arbitrage is having zero volatility standard deviation, we will be having 1.5 to 2 standard deviation. A normal balance hybrid fund and average have a standard deviation of 5. Nifty has 16. So we are almost 1/10 of Nifty volatility, and on a return side, we are around 9 to 11%. So this is an absolute return fund. This is not a product which will give you very sharp 15-16% return, but it will not give you a negative return as well. We are in the range of 9 to 11%. At least our backtesting shows you. Also my Tata performance, I will showcase how we have done in the last few years. From the strategy front, we are actually focusing on 4 strategies in our fund. This strategy is basically equity, debt, special situations and derivatives. I'll try to explain in the next 5 minutes what we are making what. From equity side, we are maintaining 35 to 40% equity. Now this 35% equity to 40% equity is getting bought into 2 things, which is arbitrage and REIT, which is 20%, and second is covered call. This is very simple. Everyone knows what is arbitrage. You buy cash, sell futures, there is zero risk to it. 20% is allocated here, but this is very important to understand. How many of you are very familiar with covered calls? Should I explain you the example of covered calls in this? Yeah, so I will showcase you one example. What is covered call? So we will go with maybe HDFC Bank. So covered call is basically you buy in cash and you sell calls. When you sell calls, you are saying I am selling an insurance, like an insurance company. Now you will only lose once there is an event. For me, the event is if the stock goes below the strike price. For example, HDFC Bank is at 743. I will sell a call of 700. 700 ka when I sell a call, I will lose only once HDFC Bank goes below 700. Before that, I will make money. Now what money I will make, I will explain you. So 700 call, or I'll give you slightly 720. 720 is what? This one, 25 rupees. Now 720 plus 25 is 745, right? and the stock is getting at 743. So there is a almost similar 720 plus 25, 745. Stock is 43, but there is a dividend attached to it. Dividend of 10 rupees you will receive. That 10 rupees is your income. Now what is your income? What is your loss? The loss is if HDFC Bank goes below 720, you are losing money. But what is the probability of that happening after 820? It is very, very less. It can remain here. Once it remains here, you still make money because you're making 10 rupees absolute gain. I'll give you one more example like a Reliance, suppose. Now Reliance is trading at 1280. Right? You will sell a call of, I will take August expiry. Yeah. So Reliance was trading at what? 1280. Now I want to tell the team what is the arbitrage you are getting here. 1200 is getting at what rupees? 93. Should I zoom it out? Can you see 93 rupees? Now we have to add 1200 plus 93 is 1293, right? You are getting the stock at how much? 1280. 2 rupees is the cost, 1282. Now what is the difference between 1282 to 1293? 11 rupees. Now that 11 rupees is your income. That 11 rupees on 1300 is 90 basis point. You getting my point? Arbitrage gives you 50 basis point. This is giving you 90 basis point. What is the risk? Risk is if Reliance goes below 1200. Now the probability that happening is very less. It can happen. And I will give you one more data point. In last 12 years, Nifty has corrected not more than 6%. How many times? Out of 144 months of last 12 years, how many months markets have corrected more than 6%? Any guess? Only 4 times. So we are giving with a probability of 97% probability you will make money in this. So covered call are basically you buying at cash, selling calls which are lower than your strike with an income of around 1% on a monthly basis. So this is how, so any questions on covered call, any other example if you want, I can give you that as well. So coming back to the PPT, you make money from your arbitrage, you make money from your covered calls. Both of this combined should make you 3.5% absolute on an annualized basis. Out of allocating 40%, if I make 90 basis point with income plus arbitrage, which is arbitrage and covered call both combined, you make 90 basis point, and when you multiply by 90, 3.5% should come from here. Debt should be around 50 to 60%, this debt. Minimum is 25, but we'll maintain 50 to 60. We will triple A we are invested into. Approximately yield will be 7%. So 5 into 7, 3.5% should come from here. So 3.5 from equity, 3.5 from debt. Without even touching derivatives, you are over and above your arbitrage returns. Arbitrage gives you what? 6%. In mutual fund, there are two categories. One is arbitrage, which gives you minimum 6%. The other category is conservative hybrid, which is actually giving you 10% plus. But there is nothing called between 8, 9, 10% returns. Our product is that. We are bridging that gap between a minimum 6 to average 10. So 7% is done. The third category is special situations. We will invest into IPOs, QIPs and blocks. Now IPOs are basically you apply into an IPO, you sell on day one itself. You don't have to wait for the IPO from a long-term perspective. You apply in an IPO in the main book. Per IPO, we should make around 1 basis point. If we do 40-50 IPOs a year, 40-50 basis points should make only from IPOs. Why I'm going to so granular things is basically that we are not a risky product. We are a very safe product, and from where we are making money and what consistency we are making money is something which I have to highlight. QIPs are basically you apply into a QIP. QIPs are now very fashionable trade in our market. Many companies come with QIP, they offer a discount and you apply in the discount, and the next 4-5 trading sessions, it come to your account, you sell it out in the market. Typical gain is 4-5%, but you don't get more than 1-2% of the allocation. So on an average, you should make around 8-10 paisa per month only from QIPs. When you annualize that, it is 1 to 1.2%. So 1.2% from QIPs, and IPOs around 50 paisa on an annualized basis. So this comes around 1.7%. When you add all three, it is 8.7%. And now then the remaining 1.5, 2% we make from derivatives. If I do nothing in derivatives, we still make 8.7. That is the reason I said we are 9 to 11 type of product. Now in derivatives, we are maximum having 10 to 20% exposure. And on the long side, maximum 5 to 10. So we could be pair trades like long one stock, short another stock, long index, short another stock. Those type of trade, shorting of options. So basically we are a premium eater. We are always like an insurance company. We sell insurance. We don't buy insurance. So those type of trade we will do. And typically we should make around 15-20 basis point on a monthly basis on this. So are we on this on the maths? 3.5 from here, 3.5 from here, 1.7 from here, which is 8.7, and 2 from here, which is 10.7. So this is how we are making our product as an absolute return fund and without even taking view on markets. Where is the market view is this? Where we can go wrong is this. If market falls very sharply, we will lose something in this. But eventually we are still of the view that we will make 9 to 11%. And these are very tax efficient in nature, 12.5 after 12 months. And this is the latest category which has got a very large sum of money. In fact, we started our NFO, we closed our NFO on 9th of July. We were at 450 crores. Today it is 25th of July. In 14 days, our AUM is now 800 crores. So this is the type of amount which we are witnessing in our fund. This month we are already up 1.2%. Within less than 2-3 weeks. On the on the market drivers perspective, how do we analyze our things is basically, obviously we look at valuations as one of our very important criteria when we do covered calls. We also look at FI positioning. At this level, FIs are very bearish at markets. Typically when they are very bearish, you have to do slightly opposite because you have to actually view market to do some short covering. Now, typically short covering happens after the expiry. So we are of the view that after 28th, we could see some bit of rally in markets. So that ways we are positioning ourselves. Then we use active calls. I'm basically a technical analyst in my career of 20 odd years. So I use basically a lot of charts, patterns, and to make money from our tactical side. And obviously we make good money from IPOs, QIPs, and buybacks. From the probable outperformance perspective, we will make definite money in rising to bullish market. I will tell you, in a rising market, now everyone is making money. You don't have to then be a very smart fund manager. You will make money in a rising market. So we are very much sure that we'll make money in the rising market. In a volatile market also we'll make money because the higher the volatility, the more premium we will get from our selling of options. IPO conducive market will make money. And what is the time horizon from an investor perspective is minimum 12 months. So there are two things why we are saying 12 months. One is from a performance stability perspective, you will see 12 months is a decent enough time for us to perform. Second is from a taxation angle, minimum 12 months is required from a 12.5% taxation. From our backtesting data fund, we have made close to 10.6% CAGR returns and arbitrage has given 6.1. However, you can see this blue line is your fund return. There has been some bit of downfall as well. That downfall is what? On a month, we have been down 1.4%. On a 6 month, we were only up 0.5%. But from a 1 year perspective, minimum 7% returns. And from a 2 year perspective, minimum 9% CAGR returns. So this is where we are focusing on, and from 1 year to 2 year, it has outperformed arbitrage by 100%. So and the average has been around 10 to 11% in both 1 year and 2 year. From a month-on-month negative, we have been negative only 3 times. In the March 2026, Jain 2025, and before that in 22. But this was a dream period for us. This one, there was a say that Har Ghar fund manager. That type of say was there. You buy anything, you'll make money. So those type of market will not come, and that is the reason I never mentioned about this 12%. This is not the right expectation. We are giving you some expectation will be, I think markets are really matured now. It is not easy to make 12% plus returns in this market. From a fund management side, myself, Abhishek and Hiten is there. Both of them have been managing close to 2 lakh crores. From a fund thing perspective, minimum is 10 lakhs and exit load is nil, and you can redeem only twice a week, which is Monday and Tuesday, Wednesday. You can come any time, but exit is only twice, and SIP of minimum 10,000. I will also want to showcase you our fund returns of Tata's. Since I was there, I will try to showcase that. So from a returns perspective, I joined in September 24, which was all-time high levels of markets, and I exited in Feb 26, which was 52-week low for markets. Not March 26. Actually, I exited in March 26, which was 52-week low. Now, markets were down 10% in that time frame of September 24 till March 26. 11 months markets were negative. This is the market negative months. 11 months markets were negative. How many months we were negative? One in Jan 25, second is Jan 26. Total return which we made was 14.5%, and Nifty was, till Feb it was 0.7, in March it was 11% down. So basically 11% Nifty was down and we were up 14.5%. So what I am trying to make is the consistency of the returns month on month. And this is what we have been delivering with Tata's. These are audited numbers, not back-tested numbers, and given to clients. So this is where I want to finish the presentation and open for question and answers.
So today this is fine. In case, like how Balance Advantage Fund has grown in the last 10 years, if SIF starts growing big and goes to large AAM, will it affect the overall returns? Because you're also shorting continuously. So more and more money comes into SIF and 40-50% of that money goes into shorting. Will it affect the overall returns actually?
No, so our returns from a derivatives fund, it will not affect us. Where it will affect us is the QIPs. Now QIPs mein what happens are qualified institutional placements. Typically a company comes with 1,000 crore QIP. We are top 5 mutual funds. We are obviously bound to get at least 10% of the pie. That is 100 crores. That 100 crores get distributed amongst our long only funds and to us. I get a pie of 25% from that. Now on 1,000 crore, it is 2.5%. On 10,000 crore, it will be 0.25%. So that is the impact of only QIPs fund. So 0.5% impact you can impact us. But the derivatives part will not impact us because it is a very big market. I'll give an example of arbitrage. Arbitrage was 25,000 crore maybe 5-6 years back. Now it is 3 lakh crores. So market already have grown up. You will see some bit of new category coming into markets and markets tend to develop. But where we will get impacted is your QIP category. Otherwise, I don't see any reason for us to get the lower returns.
And where we will position this, for an example, if somebody is a 2-year FD customer, can we position this there?
We are definitely targeting FDs from a consistency perspective. We are of the view that in 2 years, we will definitely beat FD returns and post-tax it will be more than arbitrage as well. So FDs, so since FDs are also, your view is 2 years. Give us 2 years view and you will see the consistency. Don't look at 1 to 3 months of consistency. I will rather say 6 months is more than enough for us to perform and 12 months is definitely will go to showcase you better returns on this. So for my back testing also, from my personal experience at Tata's as well, and previously I was 15 years with Bank of America Merrill Lynch, where I was managing the large HNI clients' money. So we have been doing all this for last many years. So it's bread and butter for me.
Fair enough.
Always have a kind of limits in the position size and all. So,
no, so the derivatives limit, we typically get restricted in our arbitrage fund. Arbitrage fund is 75,000 crore, our Kotak arbitrage fund. Over there, we are getting restricted to scheme-wise limit. But the limit per stock is not less than 3,000 crores. So we have enough limit for us to, from a derivatives exposure perspective. And also we have told SEBI to increase the number of stocks in the FNO side. So they are also reviewing this because they want to grow SIF as a category. So the more the stocks will come now, the more it will open up. So we are expecting at least 300 plus
No,
stocks.
that is fine, but in terms of AUM, right now you said that you started off and now it is almost 850 crores.
Yes,
As
800
such,
crores.
all the categories in the SIFs are going to increase only.
Yes.
So in that case, we really have a challenge there, right?
No, I think if देखो कैसा होता है, every mutual fund has two schemes. Though if there is a limit of 1,000 crore per stock, suppose, that will be get distributed among three schemes. So if one scheme is 70,000 crore of ours, which is arbitrage, we can definitely scale to the next scheme, which is 70,000 crores per AMC. That is the limit you have in per stock. So there is good to know that there is limit, but the limits are very big. And definitely कैसा होता है देखो, suppose if it's a 1 lakh crore suppose category, per stock will be 1%, not more than that. Then 1,000 crore is not a big amount for us. And we are managing the same in the arbitrage fund. Arbitrage fund is 75,000 crore. If we have 2% exposure in one stock, which is 1,500 crores. So whatever limits we have per AMC, it is distributed among three categories of minimum three categories. So one is 75,000, the other can be also 75,000. So I don't feel any challenge, and with number of stocks increasing, it will not be a challenge. And again, this is an absolute return fund, and you will enjoy the low volatility and high returns in this. Any other questions on this? I know I have taken after lunch, so, but still I will trying to make it a bit interactive. Anything on the covered call, on pair trades, if you want to know, I can explain you that as well. No, it will be growth type of thing. But we can have a dividend option as well, but unfortunately dividend are taxed full. So whenever you opt for dividend, your income should be below 12 lakhs. So if it's below 12 lakhs, then it is good to you have. Otherwise, it will be taxed at marginal. No, so why we take in the money, I will give you why we take in the money. देखो, Reliance you are buying at 1280, suppose. Now, when you take at the money, which is 1280 calls, you will receive a premium of how much? 36 rupees, right? This one. This one is the premium. 36 is the, if Reliance falls by 36 rupees, you are making losses. We are saying we are not taking aggressive bets. We don't want to make 36 rupees. We are okay to make 12 rupees. But we want to have lot of safety on the downside. We are not return chasers. We know किधर से कितना return आएगा. We want to cover our risk. So when you do at the money, you are risking yourself on a bull market. If bull market doesn't come, you lose money. If there's a 5% fall, for example, in this, if Reliance goes to 1200, in this at the money call, you will lose 80 rupees in your stock and 40 rupees or 38 rupees you received in this. So net you will lose 42 rupees. 42 rupees on 1200 is approximately 3%. You are losing 3%. In my example, you still make money at 1200. OTM is also further riskier. We are using derivatives to reduce our risk. So this, whenever in a bull market, this OTM and ATM will do quite well. But we are not in that bull market, and we don't want to position as a bull market product. देखो मैं आपको बोल रहा हूँ, in a bull market now, we will also make 11. Others will make 12. But I want to showcase you that we are not going down sharply. We are not risking our product from a client money perspective. Thank you all. And